Welcome to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research. My name's Rachel, and with me today is David Blake, CMT, here to discuss what happened in the market last week and what we should look for going into this week's market. David, how are you today?
I'm doing well, thank you.
Great, let's jump right in.
Well, investors were a little shaky last week and had a very volatile week for everybody. We started out, the indexes traded sharply low around the globe. We did see a little bit of buyers come in to buy the dip, and why not? For the last 2 years, every time there was a market pullback, if you bought the dip, you made money. So we did see people jump in again on Monday. They bought the big cap tech stocks. They also bought defense stocks and some of the Mag 7 stocks. They're buying those for a little bit of a flight to safety. And then on Tuesday, we came in and we had what I described in the weekly letter as a washout. A washout is where you just, no matter what it is, it's going down. And with cryptocurrencies, we had every sector down, and we were down about 11 or 1,200 points in the Dow, basically right at the open. And again, the traders stepped in and bought that dip, and they cut the losses in half very quickly. We also saw, and I talked about this in one of the daily comments. If you go back into the commentary archives, you can read about it. A lot of times when you see a washout like that, you'll see the VIX go from, say, like 18 and spike up to like 28. When it goes above 25 like that, normally you're going to see people jump in, which is exactly what happened. I'm going to jump over here real quickly. If you go to the market at a glance and you come in here and you look at the VIX down at the bottom, we have all these different things that we look at. And here on this, you saw where we had that 1,200 point washout. You saw the VIX was basically, it was around 22 the day before, spiked all the way up to about 28 and a quarter. Now, when you do that, once it gets above 25 on a spike like this, you're going to see traders jump in, because that's normally a sign where, okay, it's probably enough of the selling going on. You saw some of that back here in November. That also represented a bottom for the market at that time. Now, we had something different on Friday. Because on Friday, we ended up at 29 and a quarter, or 29.45 or something. But it was a slow climb to the top. It wasn't a boom. It wasn't a big jump like that, or it gave people a chance to buy the bottom and then come back all down here where we end up in 20 or 21. So when you see that, that's a sign that you shouldn't be buying that washout. It really wasn't a washout. But when you see a slow climb to the top on the VIX, you want to give the markets a little bit of more room. And we still ended up, I think, on Friday with the 800 point loss or something like that. Everything was pretty much down across the board. But that's just a little thing when you're looking at this with all this volatility that's going on, when you see some geopolitical events happen. If you do see that big spike, it all automatically starts to run back up positive here, or back to where it was back in the 20s or something like that. That would be a sign that maybe it's time to at least start buying some things in the market. And usually that you're going to be right when that happens. So that's just a little trader's tip to keep an eye on. Okay, so anyway, let's go back to what happened last week. We did get some better than expected economic data on Wednesday. The ISM Services Index jumped to a 3-year high. Again, we saw buying on Wednesday on the Mag 7, big cap tech again. Semiconductors continue to outperform. In fact, today, even on Monday, the Dow Jones dropped about 800 or 900 points right at the open, and semis were down for a little bit. I think they're actually positive right at the moment. They've come all the way back, and you're seeing, I think part of this is when you're wondering, what can I jump in and buy? Some of the things you're thinking, I want to be conservative. Maybe I'm going to buy like Walmart or Kimberly-Clark stocks, because people are going to need toilet paper, are going to need food, they're going to need this type of stuff. But in the new economy, of course, semiconductors are going to continue to be heavily in demand. And I think that's what you want to look at if you see a washout in this market from the war and all. You want to be focused a little bit on semiconductors, like the Broadcoms and NVIDIA again, Marvell, Lam Research. There's a lot of them. If you go into Second Opinion or do some of the screens, you'll find some of the strongest semis that you want to buy. But anyway, so you want to find some semiconductors to make sure they're probably going to still be long. And that would be something you want to take a look at with this AI-related economy that will be coming out of this war zone. So anyway, let's go back here. So midweek, we got another drop of the Dow, about 1,100 points. They bought that again on Thursday, brought the major averages off their lows in the afternoon. And we actually had if you listen to CNBC, they're talking about semiconductors rolling over, and you're actually having a little bit of a rebound in software stocks. I don't know about that. Just the fact that the software stocks actually had dropped about 30%. That's why you're getting a little bit of a buy in that. I don't think the semiconductors are going to just roll over and go down 20%. There just seems to be too much demand around the world in that thing. So, anyways, you had the iShares Tech Software ETF, IGV, rallied about 14.5% last week. So it's already starting to climb back after it's had that big pullback. So I don't know that I'd be a big buyer of the software stocks quite yet. We did get some news after they sold off that OpenAI and these companies were going to work with the software stocks. So that might help give them a boost. So, I'd read a little bit more about those right before jumping in to buy those. Okay, then Friday we had a big miss on the jobs data. With that, we also had a big spike in crude oil prices again. They jumped up over $90 a barrel. They were looking for payrolls to add about 50,000 in February, and instead we lost 92,000. So that was a big miss. That's showing the jobs market may not be quite as stable as they're hoping. And then, of course, the fact that we jumped up over about 90 a barrel, that was the first time since October of 2023, has up 36% for the week. And then we opened up today over $100. I was trying to see when the last time we were up above $100 a barrel. I read somewhere that was last time Kuwait invaded. Now, some people are saying this is going to come down. Just for comparison, the last time oil jumped over $100 a barrel during the Iraq Kuwaiti thing, it took 12 days after the conflict started to get up above 100. I think it went to about 140, but it took 148 days before the price of crude oil was able to come back down to where it was close to before the conflict started. So I wouldn't count on a spike in oil, then all of a sudden we're back down to $60. So that's going to also have some political ramifications to it with pricing inflation data to come out. Okay, with higher fuel prices, of course, you're going to see transportation stocks get a hit hard. And the Dow Jones Transportation Index was down 6.2% last week. Airlines were down 5 and 6%. The cruise lines were down. Trucking stocks were down. I just filled my gas up this morning here in Atlanta, and the high test was 398. So we're probably looking at probably $5 gas here over the next maybe week or two. So a lot of stuff like that is going on. You had the Global Jets ETF, which is the symbol is JETS. It was down more than 10% last week. I think the airline stocks were down again today. Every sector except energy was actually red last week. So the selling is pretty much across the board. And I don't expect to see much of anything. But consumer discretionary, which is going to be the one like today, it's the weakest. That's something you want to be aware of, because people with the higher gas prices, that's going to cut into everybody's wallet. And they're probably going to be spending less money on going to restaurants and the movies and that type of thing. So when you're looking to buy something, you just keep that in mind also. Okay, the technical condition of the market last week, of course, it deteriorated. We sliced through a bunch of key moving average support levels. We also saw MACD and several of the trend indicators that we look at. They slipped into bearish territory. There's something on the charts that you can look at. I'll go to that right now, called the ADXR, that I like to look at. And what that does, the ADXR, it measures the strength of the trend. Okay, you see it's gone from about 12, closed on Friday, up here at 17. Once you get more than a 4-point move in the ADX line, that means that the trend of whichever direction the market's going is getting stronger. In this case, the dark blue line is the negative directional indicator. The light blue line is the positive directional indicator. And you can see over here, let me pop it down a little bit. Okay, where they crossed right over here. We've been in that trading range, and then all of a sudden we got a DI plus DI negative crossover. That was a sign that this thing could be in trouble. Now, when you see those crossover like this, and this is actually one of my favorite trading signals, is when you see that cross there, and then you get the ADX line rising 4 points. That means that crossover is getting stronger. And as you can see from that point, when we got that, it came down, we got a little bit of a bounce, and then we rolled back over again over here. So that is something that you want to watch when you're looking at some of these indexes. As long as that thing is rising, that means that the momentum in the direction the market's going is increasing. So that's not a good sign that you're looking at that right now. We also saw the 14-day RSI. And this is another thing that you can kind of bank on. There's a woman here in town called Connie Brown, and she's noticed that on the 14-day RSI, not only does it tell you when it's overbought or oversold, and that's how most people use it, but she's noticed that when the RSI breaks below 40, in this case, not too bad yet. It'll break lower today probably, but we were at 38 on Friday. When the indicator breaks below 40, she's found that usually is a change in trend direction. So that could trade down to 20, something like that, or whatever. And that means that the momentum is probably going to continue to be lower, or the market's going to be bearish for a while. And then on each successive rally in the market, say if we get a bounce here for a couple of days, if the 14-day RSI is unable to go above 60, that just means that you reach the top of this bounce and you're probably going to roll back over. Now, if it can break above 60 and get up closer to 70, and that's a sign that maybe that sell-off is over now and maybe time or now into a more of a bullish market again. So those are just two tips that you can watch to see how much longer this sell-off possibly could last. Okay, going on from there, we did see the Dow Jones, S&P, and the NASDAQ. They're all trading below their respective 50 and 100-day moving averages. Secondary indexes, which I like to see lead the market higher and lower. They include the Dow Jones Transports, the small cap Russell 2000, and even the Philadelphia Semiconductor Index. They've outperformed over the last, say, 50 days, 60 days, something like that. But they did break their 50-day moving average on Friday. That's something to watch in there. In fact, the Russell 2000 broke below the 100-day moving average. Let me pull that up real quick. It was down pretty hard again today. And of course, you can imagine when your rates have been going up, which is a strange phenomenon in this environment, you would think the rates would start to cool down a little bit because higher gas is going to slow down the economy a little bit. But over here, you can see this is called a breakaway gap. Okay, you're going in kind of a trading range here. And then all of a sudden you have a gap lower. And I think we gapped down again today. And that's something to watch. We come down here at the 40-day RSI, broke that 40 range. And then look over here, we've got the negative DI minus is on the top. And you've got the ADX line going from 12, closed at 14.7. It hasn't done it yet. It'll probably be at around 17 or 18 after today because it was down about 40 points, the Russell 2000 earlier when we came on here. So those are some things to take a look at. I did mention about the capitulation. I think we will see that. Capitulation in a stock market is when you actually will see, like we saw on Tuesday, everybody comes in, they're throwing the baby out with the bathwater. No matter what it is, it's going down. That day crypto's down. Doesn't matter what sector, they're all being sold. And when you see that, and then you see the VIX spike up, and then all of a sudden, then they start buying it, and they bring the index even positive sometimes. That's the sign that we probably have a bottom in. I haven't seen that yet. It was close on Tuesday, but we didn't quite get that. And normally, you're going to see volume be almost double because everybody just says, I want out of here. Get me out of this market. And that's when you probably want to be going in. Now, I'd put up a couple of weeks ago some targets, downside targets for the different indexes. The downside target for the Dow Jones was 47.5. That was exceeded. We got down, hit intraday. I think we hit 47.009. So that was hit. We got the S&P 500. The target was 6,700. We got down to 67.10, I believe. Now puts the target at 65.80 to 6,600 as support. The Dow, I'm looking probably for 46.3, 46.5 is the next support level on that. The NASDAQ came within about 124 points of the 22,000 target. And today we came down right around the 22,000 again. It seems like that possibly can hold if we don't get more of a big blowout on this thing. So keep an eye on that. If the other indexes get down to where the targets are and they start to come back or snap back a little bit, then probably you're going to see the NASDAQ with the tech-heavy stocks lead the way higher on this, with some of the AI-related stuff and semiconductors. Today, again, we're having a big sell-off. Global markets are selling off. You have to understand, like some of these, like in Japan and South Korea, they're more tech-oriented indexes. Then you have something like India and some of the other ones that are more commodity heavy indexes like Australia or something like that. And so you want to kind of watch where you're going into. Today, Japan and South Korea again are down. They're down about 5%. South Korea was down like 10% in one day last week. So they're really struggling because their indexes are really slanted towards the high tech companies, and they're being beaten up a little bit more right now. They're usually the tech index is a little bit more heavier or more volatile than what we're normally seeing. But anyways, so this week there's not a lot of earnings coming out. We do have Oracle going to release their earnings on Wednesday. I'm sure they'll come out with some pretty good numbers. You want to pay attention to what the cloud revenue is expected to be. I think they're looking for around 8.7 billion for their cloud revenue. That's up from 7.9 or something like that in the previous quarter. So pay attention to that. And then we have a double dose of inflation data. We have the CPI, Consumer Price Index, for February on Wednesday. They're looking right now for about 2.5% on the headline year-over-year increase. Core CPI expected to rise about 1.4, and both of them are expected to rise about 0.3% from January. So inflation still sticky. It's pretty tough in there right now. And then on Friday, the big number comes out. That's the Bureau of Economic Analysis. They're going to put out the PCE, which is personal consumption expenditure, and that's the main indicator that the Fed watches to see whether they're going to raise or lower rates. I don't think they're going to be lowering rates anytime here with the inflation expected to spike up here with gas prices and all that kind of thing. We're going here. But anyway, for January, they forecasted around 2.9 for the headline, which is what it was in December. And then the core PCE, that was 3% in December, and they're looking for that to be 3% again, because they're running a little bit behind on some of these data points for when the government was shut down before. I don't expect to see much action and the projections for the Fed to cut rates. And in fact, I think now, hoping for March, I think now maybe even June's a coin toss. So you're seeing rates move up a little bit. So anyway, that's what we're looking at this week. Again, keep your eye on that, on a capitulation type of thing. If you're looking to jump back in, have a list of stocks that you have in your stock watch lists that you'd like to nibble on. That way, if say you get something like Tuesday where the Dow's down 1,200 points and all of a sudden everybody starts buying up, if you're looking to buy 100 shares, maybe you buy 25 or 30 shares and see what's going to happen. That way, if it comes back down again, you're not killing yourself. And maybe you'll get another capitulation another week or so later, and you can add to that position. You don't want to sit here and just think everything's rolling over and you don't buy anything, because at some point the economy has been coming up with some pretty good numbers. And I think the sooner we get rid of this war thing, things will look better. So other than that, I would say maybe just stay on the sidelines a little bit, and unless you see some of those little washout things. The CTI, which is our market timing device, went to a sell or a bearish call a couple weeks ago. And I think that certainly will stay bearish for at least this week, and looks like next week too. I believe we already took out last week's low, which will extend the CTI bearish call for at least another week. So the earliest we could switch it would be the following, not this coming Friday, but the following Friday. And again, who knows whether that'll be in there or not, but probably another couple of weeks or so before we would switch back to a bullish posture.
Very good. Thank you, David, so much for sharing all of that valuable information with us today. If you would like to try MarketEdge, your first 2 weeks are free. You can sign up at MarketEdge.com to get unbiased technical stock research updated after market close every day on over 5,000 stocks and ETFs. David, anything else for our viewers?
Yep, I think that's going to be it. These are uncertain times, and just kind of let stuff come to you. Have your list ready to go, and also look at some of the charts to see maybe where some key moving average levels are, and maybe you can put in a limit ticket. And then that way, if you're not watching what's going on all day long, like I have to do, you would be able to make a couple buys at a good cheap price. And that's one way that experienced traders will put tickets in when they're going through stuff like this.
All right, thank you. If you have questions for David or anyone on the MarketEdge team, feel free to drop a comment below if you're watching on YouTube, or send us an email to support@marketedge.com, and we'd love to help you out. Until next time. Thanks, David.
That's all, folks.
All right.